Capital or owner's equity. Funds, cash, land, furniture, etc. introduced by the owner to start business is called capital. Capital is the lifeblood of any organization. Symbols. The word started, invested, introduced, and commenced are used for it. Type of account. Capital is a type of real account because it exists at the end of the year. Nature. Capital is an internal liability. It is the obligation of the business to return the capital to the owner at the time of liquidation. What general entry is passed at the time when capital is introduced? Sometimes owners of the business start business with cash only. Example number 1, started business with cash rupees 1 lakh. Debit cash account because as cash is invested in the business, it is an asset. Increase in asset denote to debit, so 1 lakh would be debited. And at the same time, capital is an internal liability and increase in liability would be credited, so credit capital account rupees 1. Of time, owner of the business injects more than one assets into business. As example number 2, introduced business with cash rupees 1 lakh, furniture rupees 50,000 and building rupees 1 lakh. Cash, furniture and building all are assets and increase in assets would be debited. So cash would be rupees 1 lakh, furniture would be 50,000 and building account would be rupees 1 lakh debited, and the sum of all these rupees 2 lakh 50,000 as a capital would be credited. It's a compound entry because there are more than two accounts are involved. Expert says think always big and start with small. Whenever the owner of the business wants to expand his business, he will inject new assets into the business. It is called fresh investment or further investment. The amount further investment will be added in capital in balance sheet. Can be invested in any form of business like cash, car, land, building, etc. Symbols. The word fresh investment introduced or further investment introduced denotes to fresh capital or further capital. For example, sold personal land and amount is invested into business. Number 2, personal fixed deposit money invested into the business. The general entry would be debit. Cash, land or any asset that is injected into the business will be debited, and at the same time the internal liability of the business is increasing, so capital would be credited. The narration would be being fresh capital introduced into the business. Now we discuss how interest on capital is calculated. Owner of the business is on the belief that if the same amount is invested into the business, the bank will surely pay interest on the funds invested, so business must pay interest on the invested funds. It is up to the owner that how much interest he charged from the business. Normally, business pays interest at the rate of 10%. General entry would be debit interest on capital because the business is paying the interest to the owner. So, credit would be capital because income of the owner is being increasing. The narration would be being interest on capital charged. On capital is an indirect expense, so it would be shown in the income statement as operative expense, and at the same time the capital amount will be added in the balance sheet. The same entry would be passed in partnership accounts while in calculation on the interest on capital. Debit interest on capital and credit would be the capital of all the partners account. Same like that, debit interest on capital and credit capital A, capital B and capital C. The same shall be credited under the income and summary expense account of the partnership account.